This is question number 4. Question number 4. Differentiate the following tax concept. So we are supposed to differentiate between all this: judicial double taxation and economic double taxation, residence of an individual and resident of a company, fixed base and permanent establishment, credit method and exemption method of double tax relief. Okay, so let's go after this way. A, to differentiate, let's look at judicial double taxation, economic double taxation. So let's start with judicial double taxation. What is it all about? This occurs where two or more countries impose similar tax on the same tax base. This may happen in a situation of dual residence, leading to the two countries exercising rights to tax the taxpayer on the worldwide basis in each state, in accordance with the domestic laws of the respective states. Okay, if we compare that with, this is 1, this is 2, economic double taxation. Economic double taxation. What's the difference? Economic double taxation. Okay, in economic double taxation, it occurs where two different taxpayers suffer tax in respect of the same income. When a company and the shareholders are regarded as separate taxpayers, with each being required to pay its tax. The company pays tax on the profit and the shareholder pays tax again on the distribution from that profit. Are we there? That is economic double taxation. So 2 or B, let's go for B. Residents of an individual and residents of a company. Or comparing 1, residents of an individual. Let's take that first. Resident of an individual is defined as a place available for domestic use of the taxpayer in Nigeria on the relevant day. Relevant day here means 1st January of every year or any year, and does not include any hotel or rest house or any other place at which he or she is temporarily lodging, unless no other permanent place is available for his use on that day. A resident individual is a person who is domiciled in Nigeria or who stays for not less than 183 days in a particular year of assessment. Did you get that? So let's go for residents of a company. What's the difference between residents of an individual and residents of a company? Okay, so we go. A resident company is defined as the company incorporated in Nigeria. A company that is incorporated in Nigeria, regardless of state of domicile or the number of places from where it carries out its business in Nigeria, is regarded as a resident company in Nigeria. It is necessary to determine the relevant tax authority to which all the tax return of the company must be submitted in each year of assessment. So that is that. Let's go to the next. Let's go back and see what said: fixed base and permanent establishment. So look at fixed base and permanent establishment. What's the difference? So this is going to be fixed base. We'll talk about fixed base first. Let's talk about fixed base. The concept of fixed base is similar to that of permanent establishment. Fixed base is often used in tax treaties in relation to independent personal services. Fixed base is not defined in Nigerian tax law. However, certain facilities are excluded from being regarded as fixed base, namely facilities used solely for storage and display of goods or merchandise, facilities used for the collection or gathering of information. That is fixed base. Now the other part, permanent establishment. PE, permanent establishment. So what's the difference here? Permanent establishment refers to a fixed base of business through which the business of an enterprise is wholly or partly carried on. Permanent establishment includes facilities that are used as office, branch, factory, mines, etc. In the model, tax convention and tax treaties, fixed base is used for individuals, while permanent establishment is used for business entities. You get the difference? Fixed base is for individual, permanent establishment for entities. Okay, so that is that. Then the D part of the question is comparing one, credit method under double taxation relief method. What's credit method? The credit method of double taxation relief gives credit for that tax paid in the country of source against the tax due or the worldwide income of a resident. The credit is given as a deduction for the tax due in the state of residence. There are two variants of this method. Full credit, the total tax paid in foreign land is allowed as deduction from the tax due in the state, or ordinary credits. Only the proportion of tax attributable to the foreign source income is allowed as deduction from the total tax due. In this case, where the tax rate at the source country is greater than that of the resident company, relief is granted at the lower rates. Okay? Now, exemption method. Under the exemption or which is the exemption method? Okay, let's look at exemption method. Exemption method. Okay. Under the exemption method, the foreign source income is deducted from the worldwide income of the taxpayer in computing the tax payable in the country of residence. The exemption could either be full exemption, in which case the entire foreign income is excluded from tax in the resident company, or exemption with progression, that is, the foreign source income is first included in the worldwide taxable income, and then the full domestic tax rate is applied. This method has greater effect in a progressive tax rate situation. That is that for question number 4.